Hey everybody, Marty Mazzora here. August 26, 2023 with your weekly economic update. We'll do the usual. We'll take a quick look at the score of our index this week. We will look at a handful of the inputs, and then I want to spend just a couple minutes at the end on the technical picture for the S&P, the NASDAQ 100 ETF, and NVIDIA. So with regard to our macro or our general conditions score, dropped a couple points, second consecutive week we've declined to a negative 19. Odds still firmly favoring recession over continued expansion in the coming months. We'll keep you posted as things evolve. I wanted to start with the U.S. Economic Surprise Index because it pretty much comports with our little bit of rolling over here of late. So the surprise index basically gauges data as it comes out relative to what economists had previously anticipated or had forecast. And still very elevated at, call it plus 60, but coming down here of late. This is a very high level historically. No doubt it'll roll over, and I suspect in the coming weeks or months we'll get back down below zero, which won't necessarily mean that we'll be in recession. It just means that the economy is disappointing relative to economist estimates. It's definitely something to keep an eye on and to track other indicators across the economy and across markets along with it. Mortgage purchase applications this last week actually hit a 1995 low, believe it or not. So while if you talk to a realtor who's got a home listed or has a buyer, they may tell you that the market actually looks strong. Multiple offers, sales above asking price, that sort of thing, although home prices of late don't really comport with that. But what that speaks to is the utter amazing lack of inventory out there. I know we've talked about this a lot. A majority of homes out there that have mortgages of under 4%. And while some surveys suggest people would sell, they won't sell if they have to adopt a new mortgage right now with the 30-year average fixed at 7.5%. So clearly there's just no inventory. It has been helping builders. D.R. Horton posted pretty good earnings. Essentially the builders become really the only game in town. It is interesting because as the economy slows amid higher interest rates, affordability is just not there. A massive amount of Americans across certain professions and then first-time homebuyers at these rates and at these prices cannot afford a house at this point. So something ultimately is going to give. I don't think I'd be long home builders right here going forward given overall macro conditions, but we'll see. It's going to be very interesting as this distorted due to trillions of stimulus thrown into the economy picture plays itself out going forward. Consumer confidence, the University of Michigan's survey was released here this last week, and it dropped just a little bit. We've been on a nice upward trend here in both the conference boards and the University of Michigan's. Borrowing from Peter Bookvar's summary of that report, the University of Michigan's confidence index was at 69.5, below the preliminary print of 71.2, and under the estimate of also 71.2. This is a come down from 71.6 in July. One-year inflation expectations rose to 3.5 from 3.4 in July versus 3.3 in the first August read. So we had that preliminary one, and this is the next one. That's a 3-month high. The 5 to 10-year guess was 3% versus 2.9 in the last month. The University of Michigan said the positives and negatives in the economy led to differing, offsetting trends across demographic groups. Consumers perceive that the rapid improvements in the economy from the past 3 months have moderated, particularly with inflation, and they are tentative about the outlook ahead. So am I. Commercial and industrial loans still firmly in negative territory, not a good sign, as you can see how these things tend to trend going into recession. We know that from the last senior loan officer survey, lending standards for banks are getting very tight, historically tight, while demand for commercial and industrial loans has been waning. Truck tonnage also continues to roll over. This actually lost a point in our overall score this last week. And so again, obviously something that is very economically sensitive, the measure of what is being transported across the nation's highways. Chicago Fed National Activity Index is the one index within our index. They track 85 data points. It actually improved. What was a negative, I believe, 31 this last month, jumped to a positive 0.12. 45 of the inputs scored positively for July. 40 of the inputs scored negatively. And by the way, within our own index, we have 47 inputs, 21% currently score positive, 40% negative, 39% in the neutral column. And then to just finish off with the inputs to our index that I'm sharing with you this week, here is the stock to bond ratio. We use the S&P 500 to TLT, the long-term Treasury bond index. And stocks are still significantly outperforming bonds year to date, but from early July, you can see we're flat to a little bit down from that. So typically when bonds outperform stocks, it says something not so good about economic conditions. Pretty much the same look for staples versus discretionary stocks. We had a massive sell-off at the beginning of the year, so this goes up when staples are outperforming discretionary stocks. Here, as you can see, from about mid-July on, a real flattening out. So there's going to be a breakout of this range here in one direction or the other. Right now, when you consider the nature of this particular ratio, if indeed our index really is foretelling what's to come over, say, the next 3 to 12 months, then we would expect this to break out to the upside, where we'd have another stint of staples outperforming discretionary. And clients' staples are a not small core position right now in our portfolio for that reason. And then, like I said, I wanted to take just a quick look at the market. So this is your price chart. This would be a 2-year daily chart for the S&P 500. Remember, last week's last message was a video, and I drew what was the potential for a very classic, to me, looking bear flag pattern. We hadn't broken down yet. We were up in here, but I said if it does break down, then we're looking at a pretty significant drop if that pattern were to play itself out completely. I would expect some support at 43.25 and then nothing between there and about 4,200. Well, we did break out last Thursday, and Friday retested the bottom of that potential bear flag. From there, if this does play out, then we see that decline. It won't be a straight line, but it will somewhat follow that line down to this area. Longtime viewers, I've got a lot of these ghosted, but this is a pattern that has not small degree of success in both directions, bull and bear flags. And here were some, like this one played out virtually to the target before it bounced a little bit. You can see we had a flag that looks very much like the one we're dealing with here, and actually the downside overshot where the target would be. So we'll see. A lot can happen that can bring this back up in a big way. Of course, we see technical patterns fail all the time, but they are something to pay very close attention to. And again, pointed that out on the S&P last Tuesday or Wednesday, and then also pointed the same thing out for the NASDAQ 100 index, had the same action. We pointed it out, I want to say right here, and it played out just like I thought it might. So far, we've got a long ways to go before this pattern actually is validated. But right now, this with the momentum indicators and so on that I typically show you do not look bullish to me right here. So September typically is a very tough month. We will see. And then lastly, NVIDIA had just a massive earnings beat again. The stock was up over 10% in the after hours last week when it reported. And remember, I said it was a pretty bearish looking chart to me. But of course, a strong earnings report would just blow that out of the water. But I also said, even if we do end up with some new high right here, we won't even begin to come close to repairing the technical damage that's been done. We had that big thrust, and then we gave it all back and had a couple of down days, not small down days in NVIDIA. Now it's still very close to all-time highs. And, when that news came out, a couple firms raised their price targets. I was skeptical of that. And we'll see, though. Again, we're still right there pushing against all-time highs. But this looks difficult to me, at least in the very near term. We'll see how it plays out longer. As I suggested last time, NVIDIA is priced for perfection like virtually nothing I've ever seen. I listened to an analyst that kind of contradicted what I said the other day about being a very shallow, a very narrow moat. I actually disagree. I happen to know that some of their biggest customers are working on development of their own AI chips. These are very, very expensive. There's not a lot of potential users who can pay the price for these things at scale like the big ones can. And there's potential startups that are providing competition. AMD, I believe, has something in the works that'll be legitimate competition. So this just doesn't feel real good to me. I'm not saying that you should run out and short it. You may want to continue to ride this train. Maybe it does go higher. There's a lot of optimism around it. I can say one thing. Technically, it does not look good to me. So we'll see. A lot of interesting action in the markets right here. Been a difficult August, save for last week. The S&P and the NASDAQ rescued themselves. The Dow was still down on the week. But this is, as I've said over and over and over again, and I really direct this to you clients right here, it would not be responsible for us to add exposure even to the things we really like long-term, given the present overall technical and, quite frankly, fundamental backdrop. We'll continue to report to you on things as we see them in the weeks and months to come. It's going to be very interesting, I think, to put it mildly. Folks, thank you as always for watching and listening, and I'll be back Monday morning with a note for you. Take care. Bye-bye.